We're watching Cisco Systems. The company right now is down about 2.2% after reporting its earnings last night. But it was relatively good news, upbeat fiscal first quarter earnings. Orders accelerated, at least in the AI era. The outlook moved higher too. So let's see what our panel has to say about this. Keith Snyder, equity analyst at CFRA Research, and William Kerwin, equity analyst at Morningstar. Keith, what stood out to you and your rating right now, neutral?
Yeah, so it is a neutral right now. I mean, generally speaking, the results were pretty solid. Guidance, I would have liked to see a little bit better, but overall, the commentary from management on the call was upbeat. And as you were saying before, that AI spend, $300 million in orders signed. They're targeting about $1 billion for this fiscal year. That's a very achievable goal. Really, the only weakness came from the public sector, and that is kind of to be expected. I mean, that spending can be fairly lumpy, and management seemed very confident that the deals were simply delayed but not lost. And so, eventually that spend will come in. But overall, they performed very well in what we see as a very tough environment right now.
So they did say customers are investing, and their customers are investing in infrastructure, preparing for an AI era overall, but there were parts that did see some weakness. So, for example, we did see that first quarter revenue was down, product revenue fell, but services revenue increased. Within the products, networking revenue fell 23%, but security revenue doubled. So I just feel like, it wasn't a blanket win. There are parts that are good news and parts that are maybe something that we could talk about more. William?
Yeah, thanks, Nicole. We liked the earnings, and I think you have to unpack that year-over-year decline on the revenue line a little bit. This comes after 2 years of really choppy results for Cisco. There are 4 quarters of over-ordering at customers that then got followed by subsequent digestion and under-ordering. So the quarter ago, last October quarter, reflected some of that over-ordering. So we don't see that year-over-year decline as overly worrisome. And actually, we're looking at the sequential growth, which grew nicely from the fiscal fourth quarter, as positive. So we think we're in a normalized demand environment, a healthy demand environment for networking and Cisco's core markets.
And to that point, Keith, do you see customers actually now planning to make new equipment orders? They've implemented some of the past equipment that they've gotten. Do you expect a lot of new orders to come in, Keith?
Yeah, I mean, while we did see the product revenue declining, it was exactly right that they're coming up against very tough comps. And so that decline was very much to be expected. Though, the bright spot from our perspective was that product order growth. And while, 20% with acquisitions, about 9% organically, that's incredibly strong, at least from, our point of view. And given that product order growth, the outlook on the company is quite healthy. And, enterprises are continuing to order product. We're starting to see service providers pick up orders again, following, a long period of excess inventory levels at those customers. And so, the future actually looks fairly bright for the networking industry as a whole. And then, just getting into AI, we're at the tip of the iceberg right now. $300 million doesn't sound like a lot, but that's going to ramp very, very quickly, especially as we get into new deployments and the very large scale deployments. We're still very much in the test phase for these networks. And so we have a very bright outlook on that area as well.
Yeah, understood. I mean, the Splunk acquisition is done, integrated. That, I think, helped, according to what I read. William, you do have a $50 fair value. It is currently at $57.88, so you don't see upside here. But the outlook moving higher, any headwinds that you're worried about?
We don't necessarily worry about fundamental headwinds to Cisco's sales, but we think that there are lofty growth expectations priced into the stock. We still see Cisco as doing the best and having the most exposure in lower growth markets like campus networking, on-premises data centers. Management will talk a lot about the efforts to build this AI order pipeline, and we see that positively, but we think it ultimately pales in comparison to the larger other exposures that Cisco has. So we don't see it, creating growth larger than low single digits going forward. And we think the stock is implying that this AI pipeline goes to a level that we really see as unsupported by the momentum that we're seeing right now.
Look, Morgan Stanley has a $62 target, so they see a bit of upside here. When you think about the competitive landscape, Keith, can Cisco hold its own in the next 5 years?
I mean, that's kind of the million-dollar question there. You have companies like Arista who are making huge inroads into the market and capturing market share. It's going to be very interesting to see what happens with Juniper once the HP acquisition actually closes, and where HP's new business goes. The market is fairly dynamic right now. You still have Chinese competitors like Huawei trying to make inroads in the U.S. Obviously, that's being more or less blocked by the U.S. government. But there's a lot of large companies who are playing for market share, and sadly for Cisco, is as the market share leader, they're probably the ones most likely to suffer from this fierce competition. And so, while we hope Cisco can hold on to the market share, we're expecting them to kind of decline in market share over the next few years.
Yeah. Look, and these are fast-growing companies, newer companies, unlike Cisco, which is the old reliable for many investors. Final thoughts here, William. I mean, do you like some of the names that we just mentioned there, Arista, Juniper, et cetera?
Well, I think, thinking about Cisco and Arista, we see these two as the largest titans in this space, but you have to pick apart the networking market a little bit. Again, we see Cisco really excelling in slower speeds, campus environments. We see Arista as the high-speed, high-performance leader, better position in AI, but ultimately both look overvalued to us right now. So it comes down to a little bit too much AI hype priced into these stocks. We love them as companies, but shares look rich today.
Yeah. Great to see you both. Keith Snyder of CFRA, William Kerwin of Morningstar. Thank you so much. Appreciate it. Good luck there.